Hello, how are you doing? Fine. Greetings to my colleagues in other branches and my students in other branches. So you are the only one who attended the class today because of the examination period. Thank you very much for attending. Okay. Today, we will finish book 3. So far, we are done with sessions 1 and 2 of book 3. And today, inshallah, we will finish sessions 3, 4, and 5. Okay? Our class is 2 parts. The first part is sessions 3 and 4. And the second part of the class will be to finish session 5. Okay? All right. Session 3 is the accounting statements. When I say the accounting statements, what comes to your mind?
Income statement, balance sheet.
Okay. Go ahead.
Profit and loss.
Profit and loss is the same as the income statement.
Sorry.
Still, we have just one statement.
Yeah.
Missing.
Balance sheet? No.
You said the balance sheet. We have the balance sheet, the income statement, and the statement of cash flow.
Statement of cash flow.
The statement of cash flow. Okay, very good. Let's start by the aims and then continue this discussion. Aims and objectives of session 3. We have 2 main aims of this session. The first aim is to explain the use and relevance of two of the 3 major accounting statements used by businesses. The income statement and the balance sheet. So we need to know, you should be able to explain the use and the relevance of income statement and balance sheet. Okay? The second aim is to highlight and define the key terms used in the context of these accounting statements. What are the key terms used in these accounting statements? You need to be able to highlight these. Okay? So 2 main objectives, and actually they are very deep and important objectives. So these are the 3 accounting statements that we have in accounting. Okay. The income statement is also known as the profit and loss account. Profit and loss. Why? Because this statement shows you the revenues or the income, shows you the expenses, and if the revenues are greater than expenses, then the company is achieving profits, and vice versa. If the revenues are less than expenses, then the company is incurring losses. Okay. For this reason, they call it profit and loss account, the profit statement, the income and expenditure statement, or the receipts and payment account. The receipts and payments account, this in case of using the cash-based accounting, But otherwise, when we use the accrual-based accounting, it's usually in the income statement. Okay. The balance sheet is also known as the statement of the financial position, and you will know why when we talk about it in details now, inshallah. The last one is the cash flow statement. The cash flow shows what cash came in and what cash went out over a period of time. This statement is not explained in detail in your book in this session. The book assumes that we already introduced the concept of the cash flow statement when we constructed the cash account or the cash statement in session 2. So when I say that it explains or shows the cash in and cash out, what do you mean by cash in and cash out? When does the company or a business gets cash in, and when does a company or a business gets cash out? Can you give me an example when a company gets cash in?
They get profit. And when they sell something and they get the profit from it, that's cash in. Okay.
When we sell a product for cash.
For cash, of course.
Not on credit, because sometimes it is on credit, okay?
Cash.
In cash, and we receive cash, this is cash in. You are right. And when we purchase, for example, raw materials, this is cash out, because we purchase, so we pay money. Right? Very good. And this statement actually will enable the business to understand and understand the position, the liquidity position of the business. How much liquid money they have. Okay? And this is very important because without having liquid money, we will not be able to meet our obligations. We will not be able to meet our day-to-day transactions and requirements. Okay? to pay salaries, to pay for our commercial transactions, to pay for our debts, short-term debts, and so on. Okay? All right. Okay, let's start by the first one, which is the income statement. Okay, here we have something else. All right. Here in accounting, we have 5 accounting elements. 5 accounting elements. 2 of them are included in the income statement, and the other 3 are included in the balance sheet. What are they? Okay, in the income statement, the accounting elements which appear in the income statement are expenses and income. Okay, expenses and income. And the accounting elements which appear in the balance sheet are assets, liabilities, and equity. Excellent, very good. Okay, so when we say expenses and income, what do we mean by expenses? What do we mean by income? Let's see. Income statement. It reports on certain financial aspects of transactions that have taken place during the accounting period that has just finished. So this statement reports on certain financial aspects, okay, during a previous period, during the past, the previous year, for example, okay. So we usually say the income statement for the year ending. So it's a previous year in the past. Okay, very good. It does so by, how to do this, how it shows this. It does so by showing what income has been earned and what expenses were incurred in earning it. So, how much income did we earn? And how much expenses did we incur to get this income? Should we incur expenses in order to get income?
Of course.
What? How come? How?
Like I have a mobile shop, I buy mobiles and sell it.
Excellent, very good, excellent. So usually in order to get the product to sell, you need to spend some money.
Of course, yeah.
Either to get, if you are a retailer, for example, you get the product ready from the manufacturer or the wholesaler, so and you sell it. This is the expense, this is part of the expenses that you incur to be able to earn income at the end. And if you are a manufacturer, still you pay for the raw materials, for the production process, for everything, which means that still you incur expenses in order to get income. If the income is larger than expenses, then it becomes a profit. And if the expenses are greater than the income, then it becomes a loss. Okay. All right. Let's take an example. Here? Okay. Assume that we have a manufacturing company. Okay? This manufacturing company has, okay, the selling price per unit of product X is $10. Okay, of product X, selling price. The cost per unit when the company manufactured product X, they incur $7 per unit. Okay? All right. Assume that the company manufactured 100 units. So number of units produced is 100 units. Okay? All right? The company sold 80 units. Number of units sold 80 units, which means that they did not sell the whole amount produced, right? No. Okay, very good. All right. Can you tell me about the income, the value of the income the company achieved? How much income did the company achieve?
20.
Income? 20?
No, not 180.
Go ahead, think about it.
Okay. Finished product is 100.
Okay. review the detail. Selling price per unit is $10.
Yeah.
Cost per unit is $7.
Okay.
Okay. Number of units produced 100 units. And number of units sold 80 units. Okay. What happened? What I'm asking about is that I'd like you to calculate the value of the income they achieved during this period. The value of the income. When I say income, do we mean profit? Or we mean the value of the sales we achieved?
No, I think profit and the value also.
No. Here in your book, the word income means revenues, means sales.
Only selling.
Selling. How much did you receive? For how much did you sell this product? Okay? Okay. Sales. What do you mean by sales? If you would like to calculate income, revenues or sales, they're the same. Okay? So income is how much? How many units did we sell during the period? 80 units. Excellent. So it's 80 units, the number of units sold, right? Multiplied by how much? For how much did we sell the product?
$7.
No, this is the cost.
The cost, $10.
$10. Excellent. So multiplied by the selling price per unit. So the number of units sold multiplied by the selling price per unit is the value of sales, the value of income, the value of revenues, whatever you call it. Okay? All right. So how much? $80. Income. Okay? Very good. All right. Now, you need to deduct the expenses, right or not?
Yeah.
We need to deduct the expenses. As we said, you said that in order to generate income, we need to incur expenses, right? And it is given here as a piece of information that the unit of this product costs the company $7 per unit. Okay? All right. So here we have we will deduct what we call cost of sales or cost of goods sold. What do you mean by cost of sales? Cost of sales or cost of goods sold. When I say cost of goods sold, how many units did we sell?
How many?
Yes.
Sold
80. Excellent. Okay. Can you tell me about the cost of these units? Because we need $7 per unit. So how to calculate the cost of sales? 80 units multiplied by the $7. Excellent. Okay. So it's how much?
100, I think.
It's like that. 560.
Okay.
Okay?
Yeah.
All right.
Yeah.
All right. Okay. Okay. So this is the cost of sales.
Okay.
All right. But did the company just incur this expense like when they produced 100 units?
Yeah.
They produced already 100 units, right?
Okay.
Why should we calculate only the 80 units sold? Do you have any idea about that?
No, because no, actually.
Okay.
But I think because this is the main idea, the 80 is the main. The main profit.
Yes. When we talk about the income statement, we prepare the income statement for the period, for a previous period.
Yeah, of course, yeah.
We compare all the revenues we earned to all the expenses we already incurred. Okay? But actually, the other 20 units that we produced still are on hand, in inventory, on stock. They will appear in the balance sheet.
Okay.
Okay? All right? All right. And we have in accounting what we call the matching principle. This matching principle. This matching principle, usually we match revenues with expenses incurred to generate these revenues. Okay? So when we deduct or when we calculate the cost of sales or the cost of goods sold, you usually focus on the number of units sold, not the number of units produced. Okay, very good. So here we have, for example, okay. Okay. This is what we call gross profits. We call this gross profit. Okay. $240 gross profit. All right. Good. Yes, not bad. Some other expenses were incurred, such as transportation expenses, marketing expenses, general and administrative expenses, salaries, all these things are incurred. So let's call them in general, we can say like transportation, like here, expenses. We have transportation. Okay, for example, $40. We have marketing. Advertising. For example, $100. Okay, and so on. So it's 140.
60.
Minus 240. 240 minus 140, sorry. To get the net profit. Net profit.
100.
Net profit is how much? $100. Net profit. Net profit purely to the owner of the company or the owners of the company. Okay? All right. So here we can, in the income statement, we show the revenues or sales, okay, generated during the previous period. We show that we deduct then the expenses. We have two types of expenses. The first type or the first item is the cost of sales or cost of goods sold, okay? And when we deduct the cost of goods sold from the revenues, we get what we call gross profit. Okay, this is profit before deducting other expenses. Then we start to deduct other expenses such as transportation expense, marketing expense, general and administrative expenses, and so on, to get the net profit. Sometimes, of course, this is a very simple example of income statement. We have more detail. Sometimes when we say, okay, income statement after gross, you deduct some expenses, and then you say profit before interest and tax. Then you deduct the interest. So you say the interest expense. So you say profit before tax. Net profit before tax. Then you deduct the tax, the taxation, then net profit at the end. Okay? So a lot of ways of showing the income statement based on the structure of the company, based on the nature of the activity, based on different elements. So just this is a very simple example to highlight what we mean by income statement. Okay? Alright. Here we have another example as in your book. This is about a service company. This is a plumber. Paula is a plumber. Okay. And this is the income statement for the period May 1st to 31st October. Okay. I'm sorry?
In the past.
Yes, in the past period. The income, start by income, which income, sales, or revenues, whatever you call it.
Yeah.
For her, income is about the fees she received for her service, for the service she conducts. Okay, the plumbing service. Okay, so fees for work completed in period. She received fees, which means that these are revenues, income for her. For how much? $30,500. Okay. All right. Then less plumbing components used, which is like the cost of goods sold or the cost of sales, right? Because in services, when we talk about services, usually, if you remember, when we differentiate between service and physical products, we said that the services have what we call the physical evidence. Usually, in conducting any service, in doing any service, you have some physical evidence, like raw material, like some material that you use in providing the service. Okay, for example, when you go to a hotel or a restaurant, this is a service sector, right? But still, the meal that you eat, the tables that you use, these are physical evidence of doing this service. So for her, the same. She needs some components to conduct her service. Okay, and these are the costs of these components. $10,500. Okay. So when we we deducted this from this, we get what we call gross profit. Gross profit of $20,000, as here. Okay? The same. Then we deduct some other expenses, okay? Like transportation costs, petrol, repair to van, whatever, okay? Marketing costs, like advertising, and administration costs, like bank fees, mobile phone, etc. Okay? To get at the end the net profit. Net profit of how much? $18,000. Okay? All right. Clear? Okay. So these are two examples. Let's summarize what we covered in the income statement. In the income statement, we have revenues, income or sales, call it whatever we call it, sales, revenues, or income. Okay? Revenue could also be called income or sales. All right. The income is what is earned for working for that period of time. Now you prepare the income statement for a specific period of time. So this is what the company or the business earned during this period. What did we earn? Okay? All right. The cost of components used or cost of sales, not the cost of components purchased in the period. There is a difference between cost of components used and cost of components purchased. Between the cost of goods sold, cost of sales, and or the cost of units produced, right? Or purchased. You know that. We said that in income statement we only show or deduct the cost of components used, or the cost of sales, the cost of unit, the cost of goods sold, not the cost of goods produced or purchased. Okay, we agreed on that. Okay. Then when we do this, we get what we call gross profit. What is the gross profit? It is a heading used in the income statement to show the profit from activities before the remainder of the costs of running the business are deducted. Am I right? Yes. Go ahead. What did we do here? All the other expenses we incur to run the business are deducted after getting the gross profit, not before. So we get the gross profit before deducting all other expenses that we incur to run the business, right? Okay, so it is a heading used in the income statement to show the profit from activities before the remainder of the costs of running the business are deducted. Agreed? Okay. On the other hand, we have other expenses, right? Expenses cover the indirect cost of producing this period's income. We have the indirect cost, like we did not, okay. Expenses, when we incur some costs for transportation, some costs for marketing, whatever, okay? These are indirect. They are not direct costs, they are indirect, okay? Because you can't trace them. They are not traceable, or they are not related to a specific unit of product, right? When we incur some costs for marketing and advertising, are you advertising all the units, or you are advertising a specific unit? Okay, no, you are not advertising a specific unit. You only produce product X, and the advertising is handling is for promoting product X in general, right? So you are not able, now this advertising, the cost of advertising can be related to a specific unit of product X or all the units.
The what? Okay.
The advertising expense is related only to a specific unit of product X or all the units?
All units.
All the units. So they are indirect. They are not direct costs. They are indirect. Okay? All right. So the expenses cover the indirect cost of producing this period's income. Okay. Like transport costs. Of course, this is a standard heading. Usually, in many accounts in different businesses, you will find the transport costs in many businesses' income statements. The marketing costs are costs spent on advertising, usually, and other activities for marketing the product and promoting the product. Administration costs are costs used for all other costs, like any other cost, like as we said, the bank fees, the mobile phone, all the administrative and general expenses are included here. Then when we deduct these expenses, we get what we call the net profit. Okay? What is left of the income after all the costs related to it have been allowed for, means have been deducted, this is what we call net profit. So it is what is left of the income after all the costs related to it have been allowed for. This is what we mean by net profit. If the costs are greater than income, then there will be a loss rather than a profit. Okay? So it will be net loss, not this. We have net profit, and in the worst case scenario, if expenses are greater than income, then we have net loss. Okay? Clear? Now, if you get a question in the exam saying that, okay, explain the income statement or discuss what we mean by income statement, you will be able to answer this? Okay, because usually in the exam, we have a question either about income statement, about balance sheet. Usually they ask you to explain this statement, the income statement or the balance sheet. Explain the income statement, explain the balance sheet. Then you have to say what we mean by the income statement, to define it, and then explain the accounting elements included in this income statement. So you have to talk about the income, you have to talk about the gross profit, the expenses, and the net profit. And sometimes the question is more detailed. Compare between, what's the difference between gross profit and net profit? Sometimes it's like that. So you have to be prepared for this. Now you understand what we mean by this? Yeah. By the income statement? Okay, very good. Now let's start in this topic, the balance sheet. Yeah. This is the second accounting statement. Yeah. Okay, the balance sheet shows the financial position at a point in time. The financial position of the business at a point in time. Okay, as one accounting period ends and another one starts. So usually you have a balance sheet of, for example, company XYZ, balance sheet as at 31st of December 2012. As at.
What's different about what's different when the balance sheet and the same?
No, the other one
in the past.
It is in the past, describing what happened in a whole period.
Okay.
In the whole year, describing everything. We earned this amount of revenues, we incurred this amount of expenses. But the balance sheet tells you, now currently we have this amount of assets. At this point of time, at this date, we have this amount of assets, this value of assets, we have this value of liabilities, and they have this value of equity. As if it is a picture of the financial position at this point of time. Okay? So it is as at this point of time. We have three main accounting elements here: assets, liabilities, and equity. Okay? All right. Let's start by assets. When I say assets, have you ever heard about the word assets?
No.
No? Okay.
Seriously.
All right. Assets are the resources owned by the business. Resources. Okay. They are things owned and controlled by the business that can generate future benefits in the form of income or service. I'll tell you something. Let's take an example.
Okay.
Dawood, assume that you will start your own business.
Inshallah.
Inshallah. So you have, okay, you have in your bank, in the bank account, you have, assume $80,000.
$80,000, okay.
Okay, happy?
Of course I will become happy.
Okay, so you decided to start your own business.
Okay.
Okay, all right. Your business will be a manufacturing company.
Okay.
Okay, a manufacturing business. So you have the $80,000, and you will start the business. Now, what do you need to start your own business?
Manufacture?
In manufacturing, yeah, a very small factory. Let's start by this.
What I'm selling, okay. What,
anything. Decide. You can make a decision.
like clothes.
Okay, clothes.
Need machines.
You need machines. Oh, okay. What else?
Place.
You need a place. Excellent. Okay, let's start. Take them one by one. You need buildings.
Building, yeah.
Okay, so we call it. You might take an apartment. You might take a manufacturing area, but we call it an accounting building.
Yeah.
For how much to get this manufacturing area?
It depends.
How much? Yes, so give me a number. Give me a figure. Say.
In 1 year or?
It's not rent. You will purchase it.
I'll buy it.
Yes, or it's your decision.
20 million.
Let's make it 40. Again, this is a very simple example to have the clarity.
Of course, yeah.
Okay, all right, building.
Okay.
What else? You said that you need machines, machinery, equipment.
Yeah,
very good. For how much will you get the machinery?
Maybe 20.
Okay. All right. Very good. Okay. Do you need a car, a van, or something like that, so that you can?
For now, no.
No, not now.
But in the future, yeah, of course, I'll need.
You need in the future.
Yeah.
But you don't need it now.
But yes, no, I need it.
You need it? It's your decision. It's your business.
I'll need it, yeah.
You need it? Okay. So we say that this is motor vehicle.
Okay.
Motor vehicle, we call it like that. Motor vehicle. For how much?
Say $10,000.
Okay. $10,000. Alright.
Okay.
What else do you need?
Workers, I need people to work with me.
Yes, but those people will take salaries, right? Or wages. It depends on their like employment level. Okay. You need, of course, some people to hire. All right. How much still you have on hand? $10,000.
Yeah.
Do you think that the $10,000 will be enough to get raw materials and to pay the day-to-day transactions every day? Or you think that...
No, it's not enough.
Not enough? Well, how to handle this problem then? What should we do?
I don't know, actually.
You have to think.
Shall I think?
It's your business, it's your dream. You need to get some money.
I've got some money, yeah, exactly.
From where?
Investors? But, from my family, maybe.
From your family? This is a family loan? Or from the bank?
Yeah.
You might take a loan. Okay, for how much will you take the loan? How much? Yes. A loan of how much?
Another 80,000.
Another 80,000?
Yeah.
Make it 50.
Yeah.
Make it
50, okay.
It is a lot. Okay. Another 50.
Okay.
Alright. So, okay. So you will get a loan from the bank?
From the bank, yeah.
A bank loan. How much?
50.
We said $50,000. Okay. Now we have enough money to get the raw materials.
Yeah.
So okay, when you get the raw materials, they are on hand. We call it in accounting inventory. Inventory, because we have different types of inventory in any business. So if it is a manufacturing business, you have raw materials inventory, you have work in progress inventory, and you have finished goods inventory. What's the difference? Raw materials, when you purchase raw materials, you use some and you keep some in the warehouse. Okay. Work in progress, when you started manufacturing some units, but still you did not finish them, so they are like 50% complete. So you keep them until you finish working on them. We call this work in progress inventory. And when they are 100% complete, they are finished goods and they are ready for sale, but not sold yet, we call it finished goods inventory. Okay? So in general, this is inventory. Okay. Raw materials for how much?
Say 35,000.
35,000, wow.
Yeah.
Okay.
Good quality, yeah.
Okay. Good quality. Very good, excellent. Okay, very good.
Okay.
All right. So, Now,
I need more.
$35,000. Okay. You already had 10 and you borrowed 50.
60.
So 60. Now you use 35 out of the 60. Still we have how much? 25.
25, yeah.
Keep them as cash with you.
Yeah.
So that you can.
Yeah, yes. Good.
Okay. Keep in your mind something that is very important. We have what we call the business entity principle.
Principle.
Okay, the business entity.
Principle.
Yes, or convention, whatever you call it. When we talk about this principle, this means that we differentiate. There is a difference between you as an owner of the business and between the business itself. What does this mean?
Okay.
This means that when we talk about this business, what will you call the business, by the way? What is the name of your business? Huh?
My mom's name, Sophia. Call it Sophia business.
Sophia?
Yeah, my mom's name. Yeah.
Okay. Sophia, like this?
Yeah.
Business.
Yeah.
Okay. Now Sophia business is totally a different person from you. Like it's a different person. You are not the same. You are not just one person.
Of course.
Okay? The business has its own identity. It's a separate entity. Okay? Which means that when you invested the $80,000 in Sophia's business, this means that the business owes you this amount of money.
Owns me?
Owes you.
Yeah.
Owes you, like the business took this money from you.
Yeah, owner, yeah.
Okay? Although you are the owner. Alright?
Okay.
Okay. And when you purchase all these items, the building, the equipment, the motor vehicle, all these things, these are not owned by you. They are owned by Sophia.
The
business. The business.
Okay.
Okay?
Understand.
And this loan borrowed by Sophia, not by you.
The business, exactly. Yeah.
Okay?
Separate the business and.
Yes. Okay? Very good. Very good. All right. Now, these are resources owned by Sophia's business.
Okay.
These are the resources owned by Sophia's business. Okay? So, and we call these assets. Assets are what? Assets are things owned and controlled by the business that can generate future benefits in the form of income or service. All these can generate future benefits. You can use them, you can resell them, right? The inventory will be processed and manufactured. The cash will help you to meet your day-to-day transactions and all these things, right? So these are assets owned by Sophia's business. Okay, all right. At the same time, we have what we call liabilities and equity. Liabilities and equity. Liabilities and equity, we call them in general claims, in accounting claims, which means that all what the business owes others. All what the business owes others. Okay, this business owes the bank how much? $50,000. We call this liabilities. Okay? And the business owes you as an owner how much?
The business owner for me?
Owes you how much?
80.
80. And we call it equity. We don't call this liability. When we talk about the equity of the owner, when we talk about how much the business owes its owner, we call it equity, not liability. Liability is the other claims against other entities, other businesses, other parties, all parties other than the owner. When we talk about the owner, it's equity. But both of them are owed by the business. Are owed by the business to different parties. Okay? So $80,000. Equity. All right. Here is the total is how much?
50.
130.
150.
And here is the total is how much? have to calculate it. You don't
I'm
want.
very bad in calculate. That's
You
not
don't
right.
have to. You don't have to.
Why?
Think about it. This is the critical issue in the balance sheet. Think about it.
Think about.
Think about it. How much is the total here?
It's not 80.
It's not 80.
Yeah.
You're right.
65.
How much is the total? Okay. When you got the building, the equipment, the motor vehicle, and all these things, and at the end you have a cash balance, right? So, what are the sources of getting these resources?
The resource?
These are resources, right?
Of course, yeah.
What are the sources of getting these resources? How did you get, like, from where did you get the money to get all these assets?
From my own money.
Your own money only? Or,
For banks,
okay, which means the total should be?
The
same?
Exactly.
Right?
صح.
صح. Bravo, Ali. Okay. You are right. 130. Normal. The same. These are the sources of getting these resources, right? I had, like, I started by $80,000. I purchased the building, the equipment, the motor vehicle, and part of the inventory, and then I borrowed a loan from the bank of $50,000 loan. Then to get to the remaining items, and at the end I have cash balance, which means that the total of liabilities and equity should be equal to the total of the assets, because I got these from this amount of money.
Exactly.
Right? For this reason, we call it a balance sheet.
Balance, yeah.
They are in balance, and we have what is called the balance sheet equation, which is total assets equals liability plus equity. Total assets equals liabilities plus equity. This is the reason for which we call it a balance sheet. This is the reason for which we get this equation, because the assets are financed by these sources. Right? Okay. So this is the balance sheet of Sophia's business. Okay. Now you understand what we mean by assets, what we mean by liabilities, what we mean by equity in general? Okay, let's take them one by one here in the different slides. So assets are things owned and controlled by the business that can generate future benefits in the form of income or service. Okay? Like as we said here, buildings, equipment, motor vehicle, and so on. Cash. These things can be of any size and made by and may be tangible or intangible. Sometimes you have tangible assets, sometimes you have intangible assets. When we talk about tangible, something can be touched. Yes. Intangible, something that you can't touch. Like. Okay. You don't have any examples for that? Think about it.
No.
Like goodwill.
Goodwill?
Your reputation as a business.
Yeah.
Like copyright, patent. For something that you invented as a business. Yeah. These are all assets, but they are intangible. They are not tangible. Okay? All right. So here, tangible assets, things owned or controlled by a business that can be touched. For example, the motor vehicle. These are the tangible, like motor vehicles, buildings, computers, any resource owned and can be touched. Okay. Intangible assets, things that can't be touched. You can't touch them. Okay. For example, money invested in another business. Sometimes you invest money in another business. So this is an example of intangible assets. The patent, the copyright, the goodwill, all these are examples of intangible assets. Okay? We have another classification of assets. We classify them into short-term and long-term assets. Short-term and long-term. The short-term assets is cash and cash equivalents. Cash and any other asset that can be easily converted into cash. Like what? We have two other main elements. Inventory and accounts receivable or trade receivable. Okay. Why? Short-term assets, cash, and any anything else that can be easily converted into cash. When we talk about inventory, don't you sell your inventory every day?
Of course.
Which means that it is easy to be converted into cash, right?
Yeah.
The accounts receivable means what? When you sell to one of your customers on credit. When you sell to one of your customers on credit, not for cash, on credit. And he will pay, usually they pay the money back within 60 to 90 days. Okay? Which means that it is this trade receivable or this account receivable is easily converted into cash, right? Because within 2 to 3 months you will have your money back.
Exactly.
Okay. On the other hand, assume that you would like to sell your building or your car, whatever. Do you think that you can easily sell them at the price that you wish? Like within a short period of time? No. Not that easy, not like the inventory, not like the account receivable, right? Because at the end you might offer the building for sale and you wait for 2 years or more until you get the price that you are looking for, right? Okay, very good. So this is the main difference between current assets or short-term assets and long-term or fixed assets. Okay? Okay, so short-term assets or current assets we call them are cash and cash equivalents, cash, trade receivable, and inventory. By the way, trade receivable is called accounts receivable and debtors. They're the same. Debtors, trade receivable, or accounts receivable, all these things are the same, just they express the transaction or an account, an account of when you sell something on credit to one of your customers. Okay? All right. The long-term or fixed assets, assets which can't be easily converted into cash. Can't be easily converted into cash, like buildings, like cars. Okay? All right. Very good, excellent. Okay, now we understand what we mean by assets. We have two different classifications, tangible, intangible, and short-term and long-term.
Short-term, long-term assets.
Assets, excellent. Liabilities. Liabilities like here,
My own.
the bank loan, for example. Okay? They are the opposite of assets. Liabilities are the opposite of assets. They will cause an outflow of benefits in the form of income or services in the future. They will cause outflow of benefits. When Sophia's business repay the loan back, the cash, yes, it's outflow of our benefit, right? Okay. They are usually debts. Usually they are debts, okay, of the business that are or will become legally payable to other entities known as creditors. Like a bank here in this case is one of the creditors. Okay? All right. Liabilities are usually more straightforward for a business to measure than are many assets, because you know the value of the loan, you know everything. But usually the value of the building might change, the value of the equipment might change based, it differs, right? Okay. Because they are normally payments due to other entities and will be referred to in money terms. Okay. Liabilities as well are divided into two types. Okay? Yes. Short and long-term liabilities. Short-term liabilities, those that are due to be paid off within a year. Any liability that the company owes others and it is due within a year, this is a short-term or a current liability. Within the short term, within a year, it's a short term. Okay? All right. Any liability that is due to be paid off in more than 1 year is a long-term liability. Okay? Short-term liabilities like what?
I know long-term.
Okay.
Like you buy a car and you pay every month.
The car loan.
Car loan, yeah.
The car loan. Like loans in general. Usually the loan is a long term.
Exactly.
Okay? Okay. But short term might be like what? When you go to the supplier and you purchase on credit.
Okay.
We have what we call, then we have an account which is called creditors, or which is called accounts payable or trade payable. They are all the same. Okay? Okay, now the company owes the supplier some money, and this money should be paid usually within 60 to 90 days again. So this is a short-term liability. Okay? And we have what's called as well the bank overdraft. This is another short-term liability. Okay? All right. So here we have the short-term. Now you know what we mean by liabilities. You know the classification of liabilities. Okay? Yeah. Why should we classify assets into short-term, long-term, and liabilities into short-term and long-term?
Liabilities because there is a short and long.
Why should we classify them like that?
Because like you said now, creditors is less than 1 year.
Yes, which means that we should prepare ourselves to meet or to pay such amounts of, right? Okay. All right. Now, what we do this because we need to make sure when we classify assets into short-term and long-term, and liabilities as well into short-term and long-term, we need to know how much should we pay within a year, and we need to know if we have liquid money, cash and cash equivalents, that will enable us to meet our short-term obligations. Right? Because to be able to meet your short-term obligations, to pay your debts within a year, you need cash money, liquid money, cash and cash equivalents. Right? So for this reason, we classify assets into short-term and long-term, classify liabilities into short-term and long-term to decide, do we have enough liquid money? And you know about this from the value of the current assets. Do we have sufficient liquid money to pay for our short-term obligations or liabilities? Otherwise, if you don't have this, you might have a lot of money out there, like you might have huge amounts in fixed assets, but they are not easily converted into cash. How to meet your short-term liabilities? It's a big problem, right? So you, as a business, you need to make sure that you have the ratio between current assets and current liabilities at least is 1.2. Like you have sufficient current assets to meet your short-term obligations and liabilities. Okay? The last accounting element in the balance sheet is the equity. Okay. Equity, what the company owes the owner, right?
Yeah, me.
All right, you. Yeah. Also defined as capital. We call it capital sometimes. We call it net worth, owner's interest in the business, shareholders' funds, funds or shareholders' funds, shareholders' equity. All these are names of the word equity, this account. The difference between assets and liabilities is referred to as equity, right? The difference between assets and liabilities, because we said that assets is equal to liability plus equity. So means that the difference between assets and liability is the equity. Okay. Equity is thought of as the amount that owners have invested in the business. This is the amount that you invested in the business as an owner. This is the equity. So equity equals assets minus liabilities. And this is what we call the balance sheet equation. Okay? Yeah. Easy?
Yeah.
So the balance sheet includes how many accounting elements? Balance sheet includes assets, liabilities,
equity.
And equity. Excellent. You know the difference between assets, liabilities, and equity. You know different classifications of assets and liabilities, right?
About what?
Different classifications of assets and liabilities.
Yeah.
Very good. Okay. Let's take this example. Okay. Now, I'd like you have here these items. I'd like you to identify the type of each. Okay. Is it asset, liability, or equity? And if you can further classify them into short, yes. Okay. Very good. Packing machine.
Assets.
Asset. Excellent. Short term or long term?
Long term.
Excellent. Long term. Office computer.
Office computer. You mean computer?
Yes.
Assets also.
Asset. Yeah. Long or short?
Long.
Long. Excellent. Mortgage on offices.
What is mortgage?
Mortgage. It's like a loan.
No, loan is liability.
Liability.
Yeah.
Excellent.
No, it's longer or short.
You know now it's longer. Okay. School building.
Assets.
For the school. It's an asset for the school. Long term or short term?
Long.
Excellent. Copyright for a song. A copyright.
Right.
like patent, copyright. When you invent something.
Yeah. Copyright. Okay.
Copyright.
Liability, I think.
No, something that you invented.
And
you have the right. Yes, you have the right of inventing this.
Assets.
Assets.
Right.
Can you classify it into tangible or intangible?
Intangible.
Intangible. Excellent. Okay. Pay owed to employee at balance sheet date. Pay owed to employee at balance sheet date. Like the business did not pay the whole salaries yet. We have salaries payable.
Liability, I think.
Liability. Excellent. Short term or long term?
Pay on long term.
Okay. Do you think that employees will wait for more than 1 year to get their salaries?
Less than 1 year.
Excellent. It's a short term. Okay. Profit retained in the business. Profit
equity.
Okay. Excellent. All right. Let's see.
Exactly.
Here are the answer. Okay. Assets. It's a long term. The packing machine is an asset. Long term asset. The office computer is a long term asset. Mortgage on offices is a long term liability because it is like any loan. The school building is a long term asset. The copyright of a song is a long term intangible asset. Yes. The pay owed to employee at balance sheet is a short term liability. And the profit retained in the business is equity. Okay. Very good. Now we have a very good accountant with us. And here is an example of a balance sheet in your book. Okay? These start usually in the British system, they usually start with the least current or the long-term assets usually. In the American system, it's different. They start with the current assets. Here they start with the long-term assets. So they start by this is Paula's Pipes balance sheet as at 31st of October. Okay. Long-term assets. She has the van. A van as a long-term asset. Only a van. Okay. She does not own the building in which she works or anything. She owns only the van. The company owns the van. It's a service sector. So for $5,300, and then they deduct what we call depreciation. Depreciation. This is an usually for machines we have what we call depreciation because when you purchase the machine today for $100,000, for example, do you think that the machine after years will be working with the same quality? And this is what we do by this. We depreciate its value. We depreciate its value, and you have different methods of depreciation. You will study this in accounting, financial accounting courses in detail. Okay. So this is minus the 200 depreciation. Okay, so the net value here of the long-term asset is 5,100. Then they show the short-term assets like a stock of components, inventory. Stock of components. This is inventory 2,770. Debtors is no. Short-term assets. Debtors is the same as accounts receivable. Now this Paula, she provided services on credits to somebody. 510. Okay. The bank balance, they mean cash. Okay. 470. A total of short-term assets 3,750. Okay. All right. The total of assets this way is how much? Total of assets 850, sorry. 8,850 total assets. Okay. Let's talk then about the short-term liabilities. Creditors. Short-term like accounts payable, as we said, when we purchase on credit. And we have the unearned income. Okay, something that
still is coming.
Yes. Okay, you have to sell, to pay very soon, within a year. Okay, a total of short-term liabilities of 1,350. Then we have the long-term liabilities, the bank loan for the van. She borrowed money to get her van, Paula. So the bank loan is 2,500. Okay, and then we have equity. Generally speaking, in equity, yes. Generally speaking, in equity, we have the equity brought forward from the previous year. plus the profits achieved
in the same year
during this year, yes, minus any drawings.
minus any
Drawings. What do you mean by drawings or withdrawals? When the owner uses some units of its business without paying for. You take something for your personal use as an owner.
Like I have a restaurant and I eat from the same.
Yes, you eat from the restaurant. You're hungry, so you ask for some meals and you eat and you do everything without paying. So this is personal use. And as we said, there is a difference between the business and its owner, right? You have the business entity, principal. So then we deduct either you pay, and if you don't pay, then we deduct this as a drawing from your equity. Okay? All right. So at the end, the owner's equity is 5,000. When we add the 5,000 to the 1,350 short-term liabilities to the 2,500 long-term liabilities, we will get 8,850, which is the total, the same total of the assets. Okay? Very good. All right. Here is another form of the balance sheet. Fixed assets, premises, fixture and fittings, provision for depreciation, sometimes they call it. Here we have the motor van. Okay, current assets, which is a stock or inventory, debtors and so on. Like almost the same, but different ways of showing the balance sheet. Okay, all right. This way you are done with the income statement and the balance sheet. The last statement is the statement of the cash flow. Actually, it's not like focused on in this session. Cash flow statement is also known as the statement of cash flows or funds flow statement. It has some other different names. It is a financial statement showing how changes in balance sheet accounts and income affect the cash flow. Usually, when we sell a unit, we get for cash, we get cash in. When we purchase raw materials, we have cash out, okay, and so on. So usually the changes in the account of the balance sheet will affect cash if the transactions are conducted in cash, okay? The cash flow statement is concerned with the flow of cash in and out of the organization, all right? As an analytical tool, the statement of cash flows is useful in determining the short-term viability of a company, particularly its ability to pay bills. We need to know about, as I told you at the beginning of class, we need to know about our liquidity position. Will we be able to pay our short-term liabilities? Will we be able to pay our short-term obligations, our bills day to day? This is very important. So the cash flow statement is very important for this because it helps me to decide on our liquidity position, the cash balance. Okay? All right. Do you have any questions concerning this session? Any questions? No. Is it clear? Very clear. Okay. So in this session we covered the 3 accounting statements, which are
assets,
accounting statements.
Sorry, account statement, the balance sheet.
Balance sheet.
Cash flow.
Cash flow statement.
And income statement.
And income statement. Yeah. The income statement has 2 accounting elements.
Expenses and profit.
Expenses and income.
Income, sorry.
Okay. Yeah. We have the gross profit, we have the net profit. You need to be able to differentiate between them. Yeah. Then the balance sheet has 3 accounting elements. Assets, liabilities, and equity. Excellent. And we classified assets into short-term and long-term, liabilities into short-term and long-term.
Tangible.
Yes, and we know that tangible and intangible assets. We know that total assets equals liabilities plus equity. This is the balance sheet equation. And we know the role of the cash flow statement. Easy? Okay. So no questions?
Great.
Okay. Here we have this part of we have in session 4 we have only section 4.4 only according to your calendar.
Yeah.
Section 4.4 in session 4.
Okay. 4.4.
4.4.
Okay.
Section 4 is called accounting world, the accounting world, okay? It has different topics, but according to your calendar, we have to cover only section 4.4, which is the difference between financial and management accounting. All right? And this is like, it was a question in the exam many times. Yes, in the last final exam, it was a question in the exam. What is the difference between financial accounting and management accounting? And actually, we covered this difference in session 6 of book 1. When we got an introduction about accounting, we differentiated between financial accounting and management accounting, but that was just an introduction. Here we have a more detailed discussion of the differences. Let's take them one by one. There are almost 8 differences, I think. 3, 4, 5, 6, 7, 8. Yes, they are. So when we talk about, just to remind you, when we talk about management accounting is usually for internal use. Internal, yeah. It is used by the management in a business, okay? Not for publishing, like the financial accounting. Because you know the financial accounting, all these financial statements that we discussed in the previous session will be published to public, so that stakeholders can benefit out of the information, the financial information they get from these statements. They will know about your financial position through the balance sheet. They will know about if you achieve, if you are a profitable company or not through the income statement, your liquidity positions through the cash flow statement, and they can decide to lend you money if they are banks, to invest in your company if they would like to, you are looking for a partner, and so on. So the financial accounting is usually for internal and external use, for both. We usually publish the accounting information in the financial accounting, but in managerial accounting or management accounting, it is generated or prepared, the reports are prepared for internal use, to be used by the management. For example, the company is launching a new product, okay, and they would like to price this product. They would like to price the product, okay, so, all right, so what should they do? They will ask for some information about the cost of the units, right? And then they will start pricing the product as according to which approach to use in this. They have different approaches in pricing, different pricing approaches or strategies. So do you think that this is something that is confidential to the company, or it should be published to people?
The pricing?
Yes. It is confidential, right? So this is part of the management accounting then, the pricing, how to price your product and so on. Okay. So they generate the financial information at that point just for management use, not for external use. Okay? Let's start. The management accounting, a management accounting system produces information that is mainly used for management purposes within an organization. The management accounting only for management purposes, to enable management to make decisions, like the pricing decision, okay? What about the financial accounting? A financial accounting system produces information that is mainly used by parties external to the organization, different stakeholders. Okay? Clear? All right, this is the first difference. The use. For internal use or for external use? Here, internal use by management. And here, external use. Okay? Management accounting helps management to record, plan, and control activities and aids the decision-making process. It helps managers to prepare plans, to control the transactions or the activities in an organization, to make decisions on all these things. Okay? On the other hand, the financial accounting provides a record of performance of an organization over a financial year and the financial value at the end of that financial year. When you as a stakeholder, as a bank, you as a potential investor, you as a government, or whatever, different stakeholders here, you will know about the financial position of the company, the liquidity situation of the status of the company, if the company is profitable or not, through the financial accounting, the accounting statements, right? Okay, so this is, again, this is will reflect the performance of the company, and this will be used for planning and controlling This is about the past. This is usually about enable to make decisions for the future, you know? There are no legal requirements for an organization to use management accounting. No legal requirements. Here, limited liability companies must, by law, prepare financial accounts. Like companies, different businesses should prepare, they have to prepare financial statements, balance sheet, income statement, and so on. And they have some regulations to follow in preparing them, okay? Some principles and so on, by law. They have to do that. Why? Because they need to reflect, they need to support the stakeholders and financial information users by information. So they have to prepare the financial statements and conduct different financial accounting procedures by law and following some regulations. These regulations are called for example, in the States, we have what we call GAAP, the Generally Accepted Accounting Principles. So organizations there, when they prepare the financial statements, for example, and handle different transactions financially, doing their journals and ledgers and all these things, they have to follow the Generally Accepted Accounting Principles rules. They have to follow this. Everybody there in the States have to follow by law. Okay? By law. In Egypt, we have our own principles, standards, accounting standards. In Europe, they have the IFRS, okay, and so on. So it's generally, we have, by law, financial accounting should be, financial accounts should be prepared by regulations. But for management accounting, it's for internal use. So no regulations, no laws forcing people to do that. They do it because they need in making decisions. Okay? All right. Management accounting can focus on specific areas of business activities. Now you have, yes, now you have, you have different branches. You have different production lines in your business. You have different units. In management accounting, you can focus on one of these units. You can focus on one of the production lines, one of the branches, to plan for this branch, if this branch has some strengths or weaknesses. Okay? So you ask for, you can concentrate, you ask for accounting reports about this branch only. Because about this part of the activity only, not the whole organization, not necessarily to be the whole organization. Okay? For a specific purpose. But here in financial accounting concentrates on the whole organization. Okay. Aggregating revenues and costs from different operations. Now we have different branches. We will aggregate revenues from all branches or all operations. Aggregate all expenses and so on. Usually the financial accounting use totals, aggregation of the whole organization. Okay? All right. Here, the management accounting provides both a historical record of the immediate past and the future planning too. Immediate past, and the future. This is the management accounting. Okay. Financial accounting, you remember when we said income statement for the year ending. Yeah. It's a previous period, right? Yeah. Balance sheet as at. Okay, so financial accounting presents an essentially historical picture of past operations. Only the past. Here, no, of course, here for the immediate past and the future. Because we need to make decisions for the future, right? Okay, sometimes we forecast in order to launch a product, in order to buy a machine, we forecast, right? So this is management accounting. Accounting statements are produced as a once-off and also for varying periods. Here, the accounting statements in managerial accounting, we prepare it for a specific purpose. So it's a once-off. We need it for this project, for project A. And that's it. And in different periods of the year. But in financial accounting, the accounting statements are usually required to be produced for a period of 12 months. Every 12 months, you have to prepare the financial statements. Every year. Okay? No strict rules govern the way in which management accounting operates. No strict rules, like the generally accepted accounting principles, for example, is for financial accounting, not for managerial accounting. no strict rules how to prepare your reports. You can prepare them the way you want as long as the management can understand them. But for financial accounting, this will be published for everybody, so everybody needs to know how to read them. So you have to follow some specific rules. These rules will standardize the way of presenting the financial statements so that everybody can understand them when you publish them, okay? Financial accounting must operate within a framework determined by law and international and or national accounting standards. This is what we mean by the accounting standards. How to show the assets, okay? How to show depreciation, how to calculate it, okay? How to handle, how to deal with, should we follow the accrual basis or the cash basis? The accrual, of course. And so this is the standards. These are standards that will enable all businesses to follow the same way of preparing the financial statements, okay? Which is not important in the management accounting because we only need some reports for a specific purpose used by the management, right? Okay. Management accounting has no specified format and no specific required statements. A report, a statement, whatever. It depends on the decision for which the management needs these reports. But financial accounts are supposed to be produced in accordance with a format specified by the accounting standards and by law. Okay? These are the main differences between financial accounting and management accounting. Easy? Yeah. Okay, very good. So, if you have a question in the exam saying that was in the final last semester, differentiate or identify or explain the difference between financial accounting and management accounting, then you have to explain this. Okay? All right. Now here we have an example, accounting information or statement. And you need to tell me the type. Is it financial or managerial? So do not look at the other column. All right. The profit earned by a business in a financial year. Profit earned by a business in a financial year. Profit
earned by a business?
Earned. Oh, yes. Profit. Where did we get the profit from?
From selling.
Okay. I mean, from which statement?
Financial.
It's financial, but from which statement? I'm asking you. Go ahead.
I'm confused now.
No, okay, I get it. Okay. Now we have the in order to know about the profit value, okay, you need to visit balance sheet or cash flow or income statement. Which statement to visit?
Okay. The profit earned is the liability, right? Profit
you get.
Balance sheet. No, not balance sheet. Income statement.
Because in the income statement we have the income minus expenses, profit or losses. Okay. So this is the income statement. So it's financial accounting. Okay. Do not look again. Okay. The sales forecast.
What do you forecast?
Forecast, anticipate, expect something in the future. Yes.
Management.
It's management accounting because usually financial accounting is about the past. Yes, so it's management accounting. The equity of a business at the end of a financial year. Equity.
Of financial year?
Yes.
Financial accounting.
And it's equity. Equity is shown in where?
Equity in
Equity?
Equity is liability in...
yes, assets, liabilities, and equity?
Statement?
Balance sheet. Okay? Yeah. The balance sheet. You got tired. We'll break now. Okay. Alright. So the equity is in the balance sheet, so it's financial accounting. The cost of running a particular part of the business. When you talk about the cost of running a particular part of the business, not the whole organization. Management. Excellent. The amount of cash coming into and leaving a business in a financial year.
Financial.
And when we talk about cash in and cash out, this is
income.
Cash flow
statement.
Excellent. Very good. Yeah. Thank you very much. Do you have? This is the only part you are supposed to cover in session 3, in session 4. Sorry. So it's only 4.4. Okay. All right. Do you have any?
Only to know the difference between financial and management.
To know the difference between financial accounting and management accounting. Okay. Do you have any questions so far? Okay, so now we will break, okay, and come back to finish the last session, which is session 5. Okay, about budgeting.
Okay, budgeting.
Budgeting. All right. Okay, inshallah. So no questions.
No, clear.
Clear. Okay. Thank you very much, and see you after the break. Thank you.